The U.S. housing market has surprised us yet again as the median home price in the nation set another record high. But is the market really as strong as home prices suggest? In today's video, we're going to look at the latest U.S. housing market data, including some indicators that show cracks forming in the market that point to challenges in the months to come. Let's get into it. Welcome to Real Estate Watch, the channel that focuses on forward-looking real estate analysis. My name is Eric and I am a professional economist in addition to being a licensed real estate agent, so I can bring you a unique perspective that you'll be hard-pressed to find on other YouTube channels. Today we're looking at the U.S. housing market, and home prices these days are at mind-boggling levels. According to the latest data from Redfin, a national real estate brokerage, the median home price in April was $426,000 on a seasonally adjusted basis, which is now up 6.5% from the recent low point in April of last year. The reason this new record price is so mind-boggling to me is because of how much affordability has deteriorated. Yet the median home price is setting new record highs almost every month now. The average housing payment as a share of median household income was 40.5% in April, which is down slightly from the recent peak, but still shows home prices to be at record levels of unaffordability. The government generally considers a household to be cost burdened when housing makes up more than 30% of income, and we have been well beyond that level for quite some time now. One of the consequences of today's unaffordable prices is that sellers are not getting everything they want for their home, which highlights the challenges in the current market. According to Redfin, 19.7% of homes listed in April had the listing price drop from the original list price. This is the highest percentage of homes with price drops since Redfin began recording the data back in 2012. Given how unaffordable homes are to the average buyer these days, it's not a surprise that some sellers have had to drop their list price. Other indicators are also pointing towards the challenges sellers are facing because of the affordability challenges buyers are facing. The sale to list price ratio has remained below 100 since July 2022, which means that on average homes are selling below their list price, and for the last several months it has been trending steadily lower. The average number of days a home stays on the market has been trending higher the last few months after reversing course in 2023. Add it all up and the data paints a picture of a U.S. housing market that is getting harder for sellers. This begs the question, why haven't we seen a collapse in home prices if buyers are struggling so much, and why does the median price keep heading higher? On the first point, prices haven't collapsed because supply is just too tight. The month supply of homes on the market was 2.5 in April, which means that the inventory of homes on the market would be exhausted in 2.5 months at the current pace of sales. While this is up from the low point of 1.2 in the beginning of 2022, we need to remember that the pace of home sales right now is significantly lower than historical trends. If home sales were back to pre-pandemic levels, that month supply number would be below 2 months. For some context, a month supply of 4 to 6 months is generally considered to be a healthy market. So the tight supply is keeping prices from falling, but then there's the other question. If homes are at record levels of unaffordability, why are prices still rising? A lot of that has to do with the organic growth of the housing market. You see, some people are faced with life circumstances where they simply just need to buy a home. This could be because of relocation for a job, growing families that need more space, a breakup of a household, or other reasons. These situations make it very difficult to put off getting a new home, even if prices and mortgage rates are at historically high levels. I think we've reached a point in the housing market where some buyers just can't put off the purchase anymore. When we look at home sales, we can see that they have pretty much leveled out after the initial plunge when mortgage rates shot up. The homes that are selling now are likely at that organic level where those transactions just couldn't be put off much longer and wait for mortgage rates to come down. In April, the year-over-year growth in the median price came in at 6.5%, which is roughly where it was before the pandemic and in line with the historical trend. Between January 2012 and February 2020, the time between the recovery from the Great Recession and before the pandemic surge in prices, home price growth averaged 7.6%. So the growth we're seeing now in home prices has basically returned to what is considered normal. So where do we go from here? What can we expect for the rest of 2024? A lot of that depends on what happens with mortgage rates. In my recent Mortgage Outlook video, I pointed out that we are unlikely to see any relief in mortgage rates before the Fed's meeting at the end of July. They aren't likely to cut rates at that meeting, but if the next 2 months of inflation reports come in favorably, we could see them change their language to indicate rate cuts are on the way. That would be enough for the bond market to send the 10-year Treasury yield lower and mortgage rates would follow. When the Fed follows through and actually cuts rates, we'll see that trend in falling bond yields and mortgage rates continue. I still think we could see the average 30-year fixed-rate mortgage reach 5% by the end of 2024 if we get those favorable inflation reports and the Fed responds accordingly. This is what really needs to happen in order for activity to pick up in the housing market. Otherwise, I think we're just going to see more of the same. Low levels of home sales driven by necessary transactions and prices that are growing in line with historical averages. The other development I'm tracking is what happens with the commercial real estate market and whether commercial loan defaults and bank failures could trigger an economic recession. A recession would be a big hit to housing demand and may even cause an increase in supply, as sellers who have been holding out may be forced to cash in on their home's equity if they face a loss of income because of a recession. Lower demand and higher supply would send prices lower. So these are the big developments I'm watching, and I will be releasing updates on those each month. If you want to stay up to date on it all, make sure you're subscribed to this channel and hit that notification bell down below so you won't miss those videos when they come out. And if you found this video useful or at least mildly entertaining, don't forget to hit that like button on your way out. Thanks for stopping by. I'll see you in the next video.